Is the banking system about to collapse? This video is brought to you by Interactive Brokers, ranked best online broker by Barron's for the 5th consecutive year. But more about them later in the video. So you guys have probably seen this chart of unrealized gains on investment securities, and you can see in the dark blue the held to maturity securities. It's been doing the rounds quite a bit in the last couple of weeks. And here's just another chart. So US banks take hit on their bond book. Just shows the impact of held to maturity bonds. Now, if you guys, those of you that follow this channel will know, if you go back to 2020 and 2021, I called bonds the most disgusting asset class. I literally use that word, disgusting. I said they were in the biggest bubble out of any asset class at the time. So, you know, yet at this time, you know, SVB was loading up using customer deposits to buy mortgage-backed securities. I mean, just idiots, and not hedging. Now, you guys know that I've been buying some short-term T-bills and other short-term type liquid assets because I want liquidity, but I'm also getting a yield. But these guys were buying long-durated bonds at the peak of a 40-year bond bull market and not hedging. Just complete idiots. So what I want to do is just cut to a 1-minute clip, which I think succinctly puts exactly what happened to SVB.
We're going to start with this. Let's just walk our audience through how this started. Okay, Silicon Valley Bank has been around forever, but it is the bank for startups, right? It is the bank for all of Silicon Valley. During COVID, we saw a huge influx of investment into startups. This bank ballooned in the amount of deposits it had, almost $200 billion. They said, what are we going to do with it? They decide to invest in mortgage-backed securities when interest rates were super low. So, of course, interest rates go up. The value of those securities plummet. So they say, we got a shortfall. What are we going to do? And instead of privately figuring this out, they go out in the markets and they say, we're going to raise capital. And what does it do? Spooks the markets, spooks investors right around the time when a crypto bank goes under.
And so, in fact, the irony is that the two aren't connected.
They're not connected.
But everybody on Twitter is telling me, see, this is what happens when you mess with crypto.
Correct. And so horrible communication around this. You see investors, you see depositors pull their money overnight, stock tanks, and boom, next thing you know, run on the bank. The FDIC has taken it over.
So, they use customer deposits to go and buy these long-durated bonds, MBSs, and all of a sudden, you know, people are now looking at money market funds and short-term T-bills, like I've been saying on this channel. Remember, late last year, I talked about I-bonds as well. I said to my American friends, maybe you guys should have a look at it. I didn't say to buy it or sell or do anything. There was no investment advice, but I said have a look at it. So we can see deposits. People have been taking funds, their savings, their dollars out of commercial banks and into money market funds, into short-term T-bills. In fact, there's a chart, I don't have it right here for you, but there's a chart that shows that it's actually the main buyer of T-bills right now is retail. So, yeah, at this point, a bank like SVB have to now sell, you know, as people want their deposits back to go put it into money market funds or T-bills. They have to then go realize some losses on these bonds that they bought. Just crazy. But you know what? The cause of this is not rising interest rates. The cause of this, you know what the cause is? It's classic Austrian business cycle theory. What I want to do now is just share two quick clips. One from Austrian economist and fund manager Daniel Lacalle. And by the way, I'll put a link to his YouTube channel in the description below. do yourselves a favor, guys, and subscribe to it. Daniel is a very smart guy. He takes Austrian economics and uses it for investing. So definitely recommend it. And also a short clip from former president of the Dallas branch of the Federal Reserve, Richard Fisher, clearly explaining the Austrian business cycle theory and what the real problem is.
The collapse of the Silicon Valley Bank is a direct consequence of cheap money and massive liquidity injections. Central banks don't pay attention to the accumulation of risk because they see credit growth as a positive sign of economic growth. And more importantly, central banks disguise risk by implementing negative rates and injecting massive amounts of liquidity that at the same time elevate the valuations of assets and businesses that probably have no profits whatsoever and certainly see multiple expansion as their way out to continue to grow. The rise of zombie companies, the increase in lending to non-profitable technology businesses, the massive accumulation of risk is not because banks are reckless or crazy. It is because there is an incentive to accumulate that risk through negative real rates and massive liquidity injections. One may say that the solution is more regulation and more intervention, but there is nothing more regulated than the financial services sector, and certainly there is nothing more akin to intervention. There is nothing that is more evidently intervention than to disguise the price of money and the quantity of money and to make businesses take more risk for lower yields and lower interest rates. This is a direct consequence of the crazy monetary policy that has been implemented for the past 2 decades, not a consequence of lack of regulation, and certainly not a consequence of a few rate hikes after years of excess.
Well, first of all, if you look at Silvergate, or if you look at what we were just talking about in terms of Silicon Valley Bank, these are heavily venture or speculative-based customers and lendees who they were lending to. And we've been saying for a long time, Scott, Steve's been saying this as well, that these are firms that were made possible by having free money, zero cost, zero interest rates, and a very accommodative regime that, in my view, went on for far too long, as you've heard me say. So I'm not surprised here. You also mentioned that the Fed and other people keep talking about the big banks are in good shape. There's not a credit crisis. But Scott, to me, this is just a fallout from having hooked people on free money for too long. And now that we're going back to actually discounting the present value of future profits, cash flows, et cetera, against a much higher hurdle rate in a 5% world at the short end of the yield curve, or a 4% world, or if you're in real estate at a 10%. So I'm not surprised by any of this. And the question is, does it rattle the system? The Fed will exercise a put if there is a credit crisis. And what they're saying right now is they don't see it. We'll have to see if these are little tripwires that are leading us in that direction.
Because to your point, you know, when you overserve someone, there's the difference between a hangover and alcohol poisoning. And we don't know really what the fallout here is, whether this is a canary in the coal mine. Do you, and Leisman, Steve Leisman, who's still with us, raised the good question, too, of, you know, presumably because of the way that the rules have changed, that the Fed would know, theoretically, what lies beneath, so to speak. How would you address that?
I think Steve's correct. I mean, they're not living in a ignorant world. They're testing constantly. They're well aware that Federal Reserve banks and the districts are reporting back to them on what's going on. So I don't think there's a big surprise here. My favorite quote, by the way, when Ben Bernanke made the mistake of blurting out in 2013 what became the taper tantrum, My chairman at the Dallas Fed was Herb Kelleher, the founder of Southwest Airlines, the biggest bourbon drinker in America. And he called Bernanke and said, you don't go from wild turkey to cold turkey overnight. And this is, I think, I knew Steve would love that one. But still, here's the point. The Fed has been very deliberate here. It's not an overnight adjustment. It's been a fierce adjustment. And in my mind, it's correcting for, painfully, excessive accommodation for far too long.
Interactive Brokers offers the lowest margin loan interest rates of any broker, according to stockbrokers.com 2021 online broker review. With interest rates on investment loans from 4.25% to 5.5%, I can assure you that's about half of what I get charged from another stockbroker. I use leverage to make arbitrage when selling options for passive income. But remember, leverage does increase risk and should only be used in consultation with your financial advisor. Now, back to the video. It's funny, Dr. Patrick Newman shares this. Federal Reserve rolls out emergency measures to prevent banking crisis. A bank will get their money and said a second bank, Signature Bank, was closed. And he tweets, 2008 called and wants its headline back. So the government have come out with FDIC and the Fed and said that all depositors, including those that are uninsured, so those above the $250,000 limit that FDIC insures, will get their money back. So, and that will be funded by a so-called bank levy. So, once again, technically it's not a bailout, but what kind of moral hazard does this set? So we can now take customers' deposits, go to the casino, piss it up against the wall, and depositors will be looked after. Is that the message that we're sending? Shareholders and bondholders get screwed. And I agree with George Gemmon here. Basically, this creates same moral hazard as a bailout. Our entire banking system has just been given the green light to adopt YOLO as their risk management strategy. I agree. And Paulo Macro, they blinked. Shite bank, I'm going to say. Deposits fully guaranteed with FDIC losses to be paid by special assessment on the banking system. Conservative banks pay for depositors of shite banks who should have known how to arrange a daily money market fund sweep of balances. Bravo, everybody. I agree. Stephen Moriarty says risk is dead. Thanks to expanding income inequality and huge private debt levels, asset bubbles which are all connected, finance sector now controls the whole economy. A Japan-style decline now appears to be the chosen path rather than a swift GFC type decline. And Brent Donnelly absolutely nails it here. SIVB used low lending standards to attract unprofitable tech, because then took their deposits and gambled on MBS. Absolutely agreed. You want to encourage that again next cycle, ? A bit of short-term pain is necessary. Everyone knew the 250k rule and they ignored it. So they should get they could get preferential loans to fund their unprofitable moonshots. Bubble bursts and the gamblers get ruined. That's capitalism. 100% agree. That is capitalism. And the great economist Joseph Schumpeter wrote in the 1940s that capitalism without creative destruction, you no longer have capitalism. And Kyle Bass, I wish he'd get rid of that flag in his bio, but anyway. Capitalism without bankruptcy is like Christianity without hell. So George Gemmon did a tweet also that said, well, why don't we just, we bail this out. Why don't we just say, all right, all deposits at the Fed, CBDC. I mean, this is crazy stuff. So do I think it's the end of the banking system? No. Do I think this has got contagion? No. Yes, if everybody pulled their deposits from the banks, the whole system goes under, but I don't think the majority of people will do that. But we've now created moral hazard. Everyone's just going to cry to the government, to the Fed, save me, bail me out. And I can see how this could lead to CBDC, create a crisis, create a banking crisis. Oh, you want to bail out? Oh, you want your capital back? Oh, you want this back? Okay. We got this thing called a central bank digital currency. You guys can accept it or not. Up to you. And I think the majority of people we've seen over the last few years will accept anything for safety and protection. Anyway, I'm a bit annoyed, as you can probably tell. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone. I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.